Let's move on now and put the focus on earnings and stock-specific action. Indiabulls Housing Finance has seen a jump of close to 23% in profits for the June quarter. However, the provisions have seen a spike in this quarter. So to discuss this in further detail, joining us on the show is Deputy Vice Managing Director. He's Mr. Ashwini Kumar Hooda joins us now. Ashwini, good to have you on the show. Thank you for joining in. Take us through the key contours of the quarter and what has been your NII up move in this quarter, and especially on the asset quality front, how are things looking?
So this has been a very successful quarter for the company, where loan book grew at 33% and the profits grew and NII grew at 25%. There was a big milestone that company achieved, where the international rating agency Moody's associate ICRA upgraded us to AAA. This is, after 20 years that on standalone basis, ICRA has upgraded a non-bank finance company to AAA. And we are only the second standalone credit in India to enjoy this in NBFC space. So this is a very big achievement, which has led to huge fall in cost of funds for the company. And as a result, the margins of the company saw an increase of almost 25 basis points from 275 to 297 on incremental basis. On the other parts of business, credit costs have been benign, and the overall NPAs have shown a decline from 0.86% to 0.8%. The company also continues to get benefit of its digital e-home loan product. So the e-home loan product has now become 22% of incremental disbursement in home loan, which is having a huge impact on the cost to income ratio, where in this quarter alone the cost to income ratio has fallen by 40 basis points to 12.9%, which indicates that we should be able to achieve our target of less than 12% cost to income ratio within this financial year.
Right. Ashwini, last time we had spoken, you had said that the focus is also on improving the funding mix, because it's an opportune time. The cost of funds has gone down and rates have been tweaked on the lower side as well. So if you can take us through what the key tenets of the funding mix right now are, where is the reliance coming? Are you reducing the reliance on bank loans and bank borrowings, and are there any securitization plans on the anvil?
Absolutely. So as we had discussed, the bond continues to be the major currency of funding. If you look at this 3 months, then the bank term loans contribution is actually negative, -2%, whereas bonds have contributed to 77% and securitization has contributed to 16%. So almost 93% of our incremental funding has come from bonds and securitization. We believe securitization is a very value accretive for our business, and as a result we have targeted almost 10,000 crore of securitization this year, of which we could achieve 2,000 crore in first quarter itself, which is typically a weaker quarter for securitization, and that constituted almost 60% of incremental loan book that we created in this quarter. So we should continue to focus on both the bond program and the securitization going ahead as well.
Fair point, Ashwini. Pleasure speaking with you, but we're going to leave it at that. Thank you so much for joining in and taking us through the broader contours of the quarter gone by. Let's keep the focus and momentum with earnings. Just Dial has posted a steady set of numbers for the June quarter, with sales seeing a jump of 5%. The board too has approved a buyback of up to 84 crores, which constitutes 9.99% of the company's free reserves. To shed more